It's PJ here. It is Thursday, the 12th of September. I hope you're doing well. This is a bit of a market update. Before I get into that, though, I just wanted to remind everybody that today is Are You OK Day. And I've just been at an event, actually, which was a mental health and sort of check-in type event for the mortgage broking industry and finance professionals. And it was a fantastic event. Some lovely speakers shared some really interesting stories. I didn't actually know a lot about how Are You OK Day movement got started, but very, very inspiring stuff. And before I get into our top three things today, I just wanted to just be real for a moment and just say to you guys, first of all, my industry is under a lot of pressure and stress. I think you probably all know or have read about the Royal Commission and know that the broking industry, the financial planning industry has been hit reasonably hard with regulation and other stuff. And I'm not stressing about it. I always see opportunity in these things. But I do want to let you guys know that as the guy that manages your money, the guy that you turn to get you a mortgage, the person that you ask, the really serious and important financial questions about, I want you to know that I do stress about that stuff for you. And I'm not going to make a big deal out of it, except to say that, I fight the battle for you. And sometimes, unfortunately, if I have to deliver some bad news or tell you that, something has not happened the way we had anticipated it to, rest assured that I have absolutely done everything I can to fight and advocate for you. For anyone that's been dealing with me for a long period of time, you know that I really am a problem solver, and I try to get over adversity as quick as I can, because if there is adversity in something, we just have to keep working on the problem. So I just want to be real for a moment and let you know that I do go through periods of time where I get frustrated, angry, all the stuff that goes through my head around not necessarily being able to get the result that you want. So just be mindful of that when, and it doesn't happen very often, but if you want to vent anger about a result, absolutely, I'm willing to listen to that. But just remember that I'm always doing absolutely the best I can to get the best result for you. So just please put that in the back of your mind if something doesn't quite go your way. Anyway, I want to also express that if you do have any friends or are worried about people in your community that might be under pressure, the key thing is that you want someone to be able to trust you to have a conversation with them about how they're feeling, or if they're not feeling well, feeling depressed, whatever. Because the reality is, if people don't talk about it, or they are unwilling to, or don't feel they can trust anyone to talk about it, they bottle it up, and then it gets to that point where someone potentially will contemplate suicide or that sort of thing. I can't remember all the statistics today, but there's really some shocking stuff out there about, first of all, the amount of men that are taking their lives and considering self-harm, but just people in general. It just shouldn't be happening in this country. We are, I firmly believe, the absolute luckiest people on the planet with our lifestyle and everything else. So I just wanted to preface this update today by saying that and being real with you guys, because you are my family, you are my tribe, and it's important that you know that you can talk to me about any of your financial stuff, and I'm not going to judge or do anything like that. I'm going to focus on how can we solve the problem. So thank you for listening to that little rant, and please do reach out, or consider if there's anyone in your network or your community or family that you might need to reach out to, and just ask them if they're okay, and be prepared to listen. So that being said, let's talk about the markets and what's going on. So my top three things today are going to be a counter trend rally, quad 4, and sharpening the saw. So let me just explain what I mean by counter trend rally. So I'm going to flip through some data, not some data, but some screens here. Tomorrow night, or actually tonight, I should say, overnight, pardon me, got a frog in my throat. The European Central Bank is going to meet, and it's very likely that they are going to cut interest rates, and they're going to introduce some sort of stimulus plan. Now, whether that absolutely happens, we'll just have to wait and see. But it looks like they're prefacing for that event, and or have been, gearing up for that event. Now, what is that going to do? Well, what that's going to mean is that quantitative easing, which I've talked about a lot in my writings and probably a little bit in some of the videos I do, quantitative easing is where basically the central bank of that particular country or that area is buying government debt and is trying to stimulate the economy and putting a lot of debt, really it's debt, into the market, trying to get that to filter down to the consumer so that the consumer goes and spends, and so that hopefully we get the economies of that region, in the case of Europe, or the economies of a particular area growing again. And so when the ECB does this is part of the currency war, the broader currency war that we've been talking about. When the ECB does this, and even the anticipation of it has already driven the stock markets of the United States, Europe, to a lesser degree Australia, have driven them up. It's also started to put a little bit of downward pressure on rates in Europe. Having said that, we're seeing a counter trend in the U.S. at the moment. So we're actually seeing rates rising a little bit in the U.S., which is a bit interesting. Probably because as the ECB cuts rates, it means that the alternative, which is rates in the U.S. and treasuries in the U.S., the differential between the return you can get on a bond in the U.S. versus a bond in Europe means that capital is going to flow towards the U.S. and potentially end up in our bond market in the U.S. It also means that the U.S. dollar has been and continues to be somewhat strong. So right now, what I really want to say about this is this term of counter trend rally is that the economic data, and I talk a lot about data, as you know, has not really gotten any better. And the market loves stimulus. It loves quantitative easing. And it also knows that if the European guys cut rates, the worst thing that can happen for the U.S. economy is a strong dollar, because it just means the stronger the dollar gets, the exports and all that sort of stuff. It's great for the consumer in the U.S. because Chinese stuff and European stuff gets cheaper, but it really hurts companies that are global exporters, and like your Apples and your motor car guys and anybody that's exporting a good, steel industry, et cetera, et cetera. So they like a weaker dollar. And anyway, you've seen, I don't know if I can find this article, but I think it was on CNBC this morning, where Donald Trump was railing against, here you go, I love this one, this headline here. Trump says Fed boneheads should cut interest rates to zero or less. U.S. should refinance debt. So, this is just another salvo in what is the global currency war, and countries trying to lower their currency to be more competitive. And the people that get hurt in all this are you and I, because zero or negative interest rates is not a good thing, because that means we're not getting a return on our investment. And it has been shown over the last 20 years, and Japan is a great example of this, because they've had basically zero interest rates now for the better part of probably 15 years. Their economy is still stuck in nowheresville, right? So this policy has been shown to not work. So if we enter this period where all the central banks of the world start to cut and continue to cut interest rates, and last week, when we had, not last week, but the first Tuesday of September, when the RBA came out with their interest rate decision and did nothing, the following week we had articles and commentary out of our central bank, the Australian, the RBA, basically suggesting that they were kind of not wanting to do too much more yet. They wanted to see if we could get tax reform brought forward and see if the government in Australia could do a bit of heavy lifting and try to stimulate the economy. But effectively, if that doesn't happen, then they're going to have to do that. And to stimulate the economy, it means they're going to have to continue to cut rates and all that sort of stuff. So it's a very interesting dynamic that we're in. But what's happening right now is we're in a bit of a counter trend rally. So bond prices are coming down a little bit. Yields are going up a smidge. We're seeing the stock markets rally, and it's just and gold has come off a little bit, which is really weird, considering what we're probably going to be getting from both the U.S. Fed and the ECB here in the next couple of weeks. But it's a time to buy, and that's what I'm doing with all the accounts that are now being moved over to the Interactive Brokers platform. We're getting positions put on, and I thank you for all your patience, guys, around that. I'm going to get reporting established and a few other things, but the main thing I want to do right now is get the money invested in Quad 4, which is what I want to just discuss. Point number 2, Quad 4. So as I mentioned a moment ago, there is nothing to suggest right now that I'm just going to see if I can grab this recent data. That's not the one I wanted. Recent global economic data. There's other stuff here, but this one is still quite telling. So we're still in Quad 4 conditions, which means GDP in the world is still going down. It's not going up. Interest rates falling, and inflation is also falling. And this particular set of data here, this is just some data. I get this stuff every single day, and there's just different data points. But this one was really quite interesting. Japan machine tool orders, yet again, have had a negative month, and this again is not a sign of a healthy global economy. You've got PPI, that's the Purchasing Managers sort of index in China, that's negative. You've got other countries in the world where CPI data is not great. Business confidence in Australia not looking that good. So all I'm really trying to say about the data is it just doesn't support this rally and this complacency that we're seeing in markets. And I did just a moment ago have this volatility table up. I've talked about volatility before, implied volatility in particular. I'm not going to go into the maths and all that other stuff on this, but this is what you need to know. When I show you a table like this that talks about volatility, one of the things that we look at is the volatility of volatility. Now, before your head blows off your body, all you need to know about the vol of vol is that when you see a negative volatility in any given asset class. So here's a great example, right? S&P 500, this is the SPY ETF in the US representing the S&P 500. It has a negative 42% implied volatility. It's a volatility discount. And what that means is that people they're complacent about risk. They're not buying protection. In fact, they think this is a measure of the fact that they think that the market is out of the woods. It's okay. You don't need to buy any protection for your portfolio, hedge it, that sort of stuff. And typically what happens when you see these deep implied volatility discounts is that it's not a guarantee, but it's often a sign that you've reached a point in the market where there's going to be an inflection. And in this table, if you look at it, you can see here that 1 month ago, you had implied volatility premiums. In other words, something bad was going on in the market, and this probably is around the time we had the market selling off. You actually had people paying to get protection. So this is kind of a measure of puts and calls and all this, and I'm not going to go into all of that. But that's really, to boil it down for you, that's what you need to know. When you see a negative number there, a discount, it means to be wary. And when you see a big premium, it means that you probably want to be cautious. So let me just explain that real quick. When I say be wary, the market is going up right now. So S&P 500 getting some new highs, going up. There's an implied volatility discount. That's bad. That means that people might get caught off guard if something doesn't quite go their way. We're going to see that flip, and we're going to see a big sell-off in the market, potentially a couple of percent, maybe 3-4%. When there's a big premium in the market, it means that we've already had that. So what will happen is after we get a sell-off in the market, you're going to see this implied vol discount flip to a premium, and it will mean that people are basically too late. They should have bought the protection on their portfolio, or if they do trade options and things like that, they should have bought protection or just got out of the position when there was a discount. I hope that kind of makes sense. I will talk about this a lot and more often. So if you don't quite get your head around it right now, that's cool. It took me a while to sort of get my head around the implied volatility and how to read it and what it all means. So anyway, that's something that I'm going to continue to educate you on. What it means, though, just to lock that off, what it means right now is, and it goes back to my point one, that counter trend rally. We're actually in a counter trend rally. We are in a bear market trend in most of the market. And so you will get lower highs. You'll get rallies inside of declines. That is the way the market works. That's what happens. You get rallies inside of declines. And I've shown you a lot of charts over the last few weeks and months since I've been doing videos, and a lot of the charts, from left to right, you see that line. It's going down. You see where the market was much higher a year ago and is much lower now. But in between all of that, you see little rallies. They'll come up and then they'll sell off, and that's exactly what this implied volatility stuff is all about. And that's what I'm trying to teach you and educate you on right now. So my final point: sharpening the saw. There's an old saying. I think Abraham Lincoln was coined with saying that if he's got to chop a tree down and it's going to take him 4 hours to do it, let's just make up a number. It's going to take him 4 hours to cut down a tree. He's going to sharpen the saw for 3 of the 4 and spend an hour cutting the tree down, right? So it's all about getting as honed and precise as you can, so that you can hopefully make the best and most the decision that's got the best probable outcome. And so the message that I want to leave you with on the sharpening the saw concept is that I use data like this every single day. My job is to do what you don't want to do every day, which is look at this crap, right? And I shouldn't say crap because I love it, but is to look at all this stuff, all this data, and try to distill it down into what is happening in the market today and going forward, and having that whole thing happen. Not whole thing happen, but all of that data, work for you. And so if you can allow me to do that for you and to be sharpening the saw, that is what my job is to do for you. So hopefully, so guys, having said all of that, I hope that you have realized and understood that every single day I'm trying to figure out what the market is telling us and how we need to position our portfolios to take advantage of that. So with that being said, I hope you check in with someone who might need your help to check and see if they're okay. And I will look forward to chatting with you soon.